In today's video, we are talking about auto financing the smart way. Understanding car loans can help protect you and your family from predatory practices by the dealership. With that, let's get started. In at number 5, we're tackling those pesky miscellaneous expenses. Now, when you're at the dealership ready to make a deal, the last thing you want is to be surprised by hidden costs. These can include dealer fees, optional extras, and a myriad of other charges that might not be immediately obvious. So, let's be smart about it. Instead of adding these costs to your loan amount, which would increase your principal and the amount of interest you pay over time, consider itemizing these expenses. Make a list, understand what each charge is for, and then pay for them in cash. Yes, you heard that right. Paying for these miscellaneous expenses in cash can save you from paying interest on them in the long run. You might be thinking, but I don't have that much cash on hand. Well, that's where planning and budgeting come into play. When planning to buy a car, factor in these expenses and save accordingly. It might take a bit more time, but trust me, your wallet will thank you later. Remember, when it comes to extra expenses, cash is king. Sliding into number 4, let's talk down payments. When you're standing in that dealership, it's easy to get drawn into the allure of zero down payment. But remember, the less you pay up front, the more you pay in the long haul. Here's a tip from the experts that can save you a ton of money over the life of your loan. Aim for at least a 20% down payment. Why 20%, you ask? Well, the more you put down at the start, the less you have to borrow. This reduces the principal, which is the amount you're actually borrowing, and that, in turn, reduces the total interest you pay over the life of the loan. It's like taking a shortcut on a long journey. You're getting to your destination. In this case, owning your car outright, faster and more efficiently. So next time you're negotiating that new car deal, remember that a higher down payment can be your secret weapon. It may seem like a big chunk of change now, but it's an investment in your future. A hefty down payment now can save you a mountain of interest later. At number 3, we've got your credit score. This 3-digit number is more than just a number. It's a reflection of your financial behavior and a significant factor in determining your car loan's interest rate. Lenders often reserve their best rates for those with a credit score of 750 or higher. If your score falls below this benchmark, you may find yourself facing higher interest rates. This can mean shelling out more money in the long run. So before you step foot in a dealership, make sure you know where you stand. Get a copy of your credit report, review it for any errors, and take steps to improve your score if needed. Remember, a higher credit score can lead to a lower interest rate, which means more money in your pocket. Your credit score is your key to a better rate. Don't let it catch you off guard. Before we continue, please consider subscribing to our channel for all the latest personal finance tips and tricks. As always, the more informed you are, the better off you will be. Coming in at number 2, we're looking at loan terms. Now, it's not uncommon for dealers to entice you with the promise of low monthly payments. Sounds great, doesn't it? But here's the catch. These often come with longer loan terms. Let's say you're considering 2 loan options. One with lower monthly payments spread over a longer period, and another with slightly higher payments over a shorter term. It's tempting to go for the first option, isn't it? But here's where you need to exercise some caution. The longer your loan term, the more interest you'll end up paying over time. It's like this. You're stretching the same amount of money over a longer period, which means the lender gets to charge you interest for a longer time. So while those low monthly payments might seem like a good deal on the surface, they could actually end up costing you more in the long run. Remember, a car is a depreciating asset. It loses value with each passing year, so the longer your loan term, the more likely you are to end up in a situation where you owe more on the car than it's actually worth. That's a situation you definitely want to avoid. Don't be lured by low monthly payments. A longer loan term might just cost you more in the long run. And finally, our number 1 tip, affordability. Now, this might seem obvious, but you'd be surprised how often this crucial point is overlooked. When you're in the market for a car, it's critical to focus on what you can actually afford, not just what the dealer convinces you that you can afford. Let's be honest, those shiny new wheels can be incredibly tempting. But remember, a car is a depreciating asset. It loses value the moment you drive it off the lot. So, it's important to make financial decisions that won't leave you in the red down the road. Now, if you're in a position to buy a car with cash, that's a fantastic option. It's the most economical way as you'll avoid interest charges and loan fees altogether. But we understand that's not feasible for everyone. So if you do need a loan, be pragmatic. Don't simply accept the first rate you're offered. take the time to research. Look at different lenders. Banks, credit unions, online lenders, they all offer auto loans. Compare the rates, but also consider the repayment terms and any potential fees. Keep in mind, a lower monthly payment might seem attractive, but it often means a longer loan term, and ultimately, you end up paying more in interest. So, do your homework and find a balance that suits your financial situation. And a final note on loans, remember to factor in the total cost of the car, including the principal, interest, and any additional fees, not just the monthly payments. This way, you'll have a clear picture of what you're really committing to. Remember, buy what you can afford, not what you desire. Your wallet will thank you. Well, that was a whirlwind of tips. Let's hit the brakes and summarize. When it comes to car buying, it's crucial to manage those miscellaneous expenses. Remember, dealer fees and optional extras should ideally be itemized and paid in cash. Your down payment is another key aspect. Aim to put down at least 20% of the car's value to reduce your principal and total interest paid. Next, your credit score can make a big difference. A higher score often means lower interest rates, so it's worth checking and working on it. Be mindful of your loan term as well. It may be tempting to opt for lower monthly payments over a longer term, but you could end up paying more interest in the long run. Above all, prioritize affordability. It's not about what the dealer says you can afford, it's about what you know you can manage. Your dream car is no good if it's not within your budget. And that's a wrap. We hope these tips help you finance your car the smart way. Until next time, stay savvy, car buyers.